David, we're going to get straight on here with the Silicon Valley Bank, and you're leading off with a graphic.
Context. This is a graphic that shows all of the United States bank failures since the year 2000, and gosh, there have been quite a lot. But we see here the two big ones, Washington Mutual at $307 billion and Silicon Valley Bank at $209 billion, dominate this picture. And this is the second largest bank failure in United States history. And obviously, $209 billion is not what it used to be, but in at least nominal terms. And that gives you an idea of the scale of the problem.
David, we should just say very quickly that, of course, the situation is slightly different in the UK because lots of independent banks in the United States, if we were to consider in the UK the number of bank branches that have been closed by the big four high street banks, we may have a similar picture.
Maybe, and there are significant differences between the United States and the UK in this particular area, because this is a bank that served the tech sector, which is huge in America in terms of the amount of the stock market value devoted to that, and is tiny in Britain. In Britain, the thing that matters most is the financial sector, and there is always very rapid response from the Bank of England, from regulators, whenever that one's threatened. And we're seeing a somewhat similar response from the American regulators to defend the tech sector, which was hugely reliant on this particular bank.
Yeah, okay, now we've got a little bit of video here, and maybe we should need to put a bit of context on it because it is from Mary Poppins. It shows a bank run, but I mean, I think the main point here is how little it takes to get one of these things going.
Yeah, I mean, it was a wonderful piece of film. So the background here is a small boy goes in and he's got tuppence and he wants to buy some bird seed to feed the birds at the park. And the bank manager finds out he's got tuppence and he wants it to be invested. And there's a dispute between the bank manager and the boy, and the bank manager eventually grabs the money. The boy's not happy, shouts that he wants his money back, and then things start happening. Now, the truth that this is referring to is the problem that all banks face, every bank faces, that it borrows short and lends long. The time element on its lending out is very long term, but almost all of it's borrowing, and it's when we deposit money with the bank, it is borrowing funds from us. Legally, that's what's happening. They tend to be very short term or very often immediate on-demand deposits. So if everyone turns up at one time and wants the money, they don't get it because there's a liquidity problem. It's called the bank run, a glorious thing and lampooned here beautifully in Mary Poppins.
Give it back! Give me back the money!
Michael, behave! Michael, behave! Jane!
Give
Jane!
me back my money! Give me back my money!
There's something wrong. The bank won't give someone their money.
Well, I'm going to get mine. Come along, young man. Every penny in yours.
And mine too.
And give me mine, too. Stop all payments! Stop all payments!
And David, while that's mildly amusing, of course, it hasn't been amusing over the last few days for many of the people that have been customers of this particular bank. And, they have needed to get money out in order to pay salaries. And in the US, people paid on a weekly or 2 weekly basis often. So this is problematic. They don't have time to wait.
Indeed, this is the case. And of course, we've seen outflows from the bank in the billions, 40 odd billion, in an hour? So it was vast. And of course, the modern technology we have now means everything happens so much more quickly. And the bank went from, you're going to do this in detail shortly, but it went from being solvent to insolvent within a day or so. And the regulators and everyone else was left running around trying to sort out the mess, trying to respond with very little time to do so.
So let's just have a look at what did happen. So here's the statement on the SVB website. On Friday, March the 10th, 2023, Silicon Valley Bank, Santa Clara, California, was closed by the California Department of Financial Protection and Innovation. Subsequently, the Federal Deposit Insurance Corporation was named receiver. No advance notice is given to the public when a financial institution is closed. To protect the depositors, the FDIC created the Deposit Insurance National Bank of Santa Clara to allow depositors access their insured deposits in time to open accounts at other insured institutions. Now, of course, if you're a business, the level of insurance which is offered, which in fact in the United States is significantly better than the UK because it's $250,000 over here as opposed to £75,000, £80,000 here, whatever it is. For a business, that's not a huge amount of money because, of course, they've got multiple salaries to pay and so on. So, look, let's look at what led up to this. So the question is, what happened? Basically, what happened was this. During the pandemic, SVB experienced a massive inflow of deposits, and their deposits jumped from $61.76 billion at the end of 2019 to $189.2 billion at the end of 2021. As these deposits grew, SVB could not expand their loan book fast enough. So in other words, they couldn't lend the money out quickly enough. And so holding cash is never going to make them any money. So they wanted to invest this cash. They decided to do that by buying over $80 billion worth of mortgage-backed securities. Now remember, mortgage-backed securities are the financial instrument which caused the 2007-2008 crash, or at least was at the core of that. These assets, in inverted commas, went onto their hold to maturity portfolio. Now, the assets, mortgage-backed securities, basically mature at a certain date, and you get your money back plus whatever the interest on that is at that maturity date. But of course, you can trade those mortgage-backed securities in the meantime. And so long as circumstances are right, you might still make a little bit of money. But if circumstances go wrong, you don't. So here's what happened next. 97% of these mortgage-backed securities were 10-year or greater maturity. So these SVB attempted to hold this stuff on their books for a very long time as illiquid resources. But in the meantime, the Federal Reserve Bank raised interest rates all the way through 2022 and continued to do so in the first quarter of 2023. So the value of SVB's mortgage-backed security assets fell sharply because US Treasury bonds now provided 2.5 times the yield that the MBS did. So then what happened was, or at least this would not have been a problem so long as SVB maintained their deposits, since they would receive the full value of the MBS at maturity after the 10-year period. But the higher Fed interest rates also reduced the appetite for initial public offerings, so setting up share issues for many startups and made it more expensive for these startups to raise funds privately. And so some of these startup clients began pulling money out of SVB to meet their liquidity needs because they needed money in the meantime. So then what happened was that SVB, in order to meet these liquidity needs, was forced to sell £21 billion of their available for sale securities, and that was at a $1.8 billion loss. And then they announced that they needed to raise a further $2.25 billion in equity. And this further $2.25 billion requirement came as a complete surprise to investors. And so the bank run began. So that is it in a nutshell. And it didn't take much to trigger the thing. But David, let's have a look at what ZeroHedge had to say.
Yeah, so they're saying, well, actually, this bank followed exactly what the regulator thought was wise and prudent banking practice. So he's saying as of December 31, 2022, they had $209 billion in total assets, $175 billion in total deposits. And they had the shareholders, Vanguard Group had 11% of the shares, BlackRock had 8%, State Street had 5.2%, and the Swedish pension fund, Electa, had 4.5%. So they were going along with the flow. They were doing "Don't Fight the Fed," and everything was fine. But everything was suddenly not fine. So ZeroHedge writes, what happened in 2021? Massive success. unfortunately, this is also the first step to its demise. Bank deposits nearly doubled with the tech boom. Everyone wanted a piece of the unstoppable new tech paradigm. The SVB's assets rose and almost doubled. The bank's assets rose in value more than 40% with long-dated treasuries and mortgage-backed securities. The rest was seemingly world-conquering new tech and venture capital investments. Most of these are low-risk bonds, and this is how they were categorised by the regulator, were held to maturity. They were following the mainstream rule book. Low-risk assets to balance the risk in venture capital investments. When the Federal Reserve raised the rates, they were presumably shocked. The entire asset base of SVB was one single bet: low rates and quantitative easing for longer. So when the quantitative easing stopped and the low rates stopped, and inflation was not transitory and easy money was not endless, then the rate hikes happened and they got caught with the bank suffering massive losses everywhere. Goodbye bonds and mortgage-backed security price. Goodbye tech new paradigm valuations. Hello panic. A good old bank run. Despite the strong recovery of SVB shares in January, mark-to-market unrealised losses of 15 billion were almost 10% of the market capitalisation of the bank. Wipeout. So
just to correct that, that's almost 100%. Almost 100% of the market capitalisation of the bank.
Yeah, thanks. I beg your pardon. Yeah, so essentially they followed the advice of the regulators. These were very, very safe bonds. And what we're seeing here is the strange effect that the Fed is having on the bond market. Bonds are meant to be boring. Bonds are meant to just be super safe. Well, this is no longer the case.
And it wasn't the only bank to suffer problems over the last few days. So here's Silvergate Bank. This bank is gone as well. It actually was put into liquidation on the 8th of March. As you can see on their website, the website hasn't been updated to reflect that. It says, effective immediately, Silvergate Bank has made a risk-based decision to discontinue the Silvergate Exchange network. All other deposit-related services remain operational, except they don't as of the 8th of March. So that one is gone as well. That's a relatively small bank, I think at $14 billion. And then we had the contagion starting. So Signature Bank of New York, their stock fell by 23%. After regulators seized stricken rival, talking about what we've just been discussing. They were forced to then, Signature Bank was forced to make a statement saying, don't worry folks, everything's fine. And so the question is, does anybody believe that? So then what have we got? FDIC creates a deposit insurance national bank of Santa Clara to protect insured depositors. Again, just to reinforce, this was the initial response. We'll have a look at what the Fed is going to do about it in a minute, but this was the initial response. And of course, this is about insured money, not uninsured money. So any money above 250,000 goes. But here in the UK, there's of course was an SVB UK subsidiary. Their website is still up. It looks like this. For the bold, driven, unstoppable visionaries. Sadly, it was very much stoppable, and they didn't have enough vision to see that it was stoppable. But this was a statement over the weekend. Silicon Valley Bank UK update. We're announcing that following conversations with the Prudential Regulatory Authority, there is an intention, barring any intervening event, to put Silicon Valley Bank UK Limited into insolvency from Sunday evening. So that was that. Now, we'll come on to what the Bank of England response and the government response to that was in a second. But in the meantime, we started to see stories. For example, Silicon Valley Bank paid out bonuses hours before seizure. So many people may be a little bit upset about this. Now, these bonuses were for work that was done in 2022, and some may hold the view that that was fair enough because the work was done and the people should get paid. Others may hold the view that actually, since the bank has gone under and since many of the clients of the bank are losing their money, then perhaps the employees of the bank should be losing their money as well. You may have a view on that. And then we had this. Breaking before the collapse of Silicon Valley Bank, executives sold a lot of their shares. So the CEO sold 11% of his shares on February the 27th. The General Counsel, 19% on February the 5th. The Chief Financial Officer sold 32% of his shares on February the 27th. And the Chief Marketing Officer sold 25% of her shares on February the 1st. And this Twitter user saying unusual. Much of this was part of a trading plan, which was started agreed the previous year. So it was perhaps, although it's unusual that bearing in mind they must have appreciated, or maybe they didn't, the situation they were in, that they were busy selling shares, personal shares, right up to the point of collapse. So then what happened to the stock market? Well, in the UK, this happened on Friday. So not a massive fall, daily fall, not the biggest daily fall that we've seen by any means, but still significant, 1.67%. But it was the bank's shares that were getting more hammered. So here's NatWest on Friday, 2.5% down. Lloyd's 3.27% down. Barclays 3.67% down. HSBC just 4.59% down on the day on Friday. But then HSBC came riding to the rescue. And a deal was done over the weekend between the Bank of England, the Treasury, and HSBC. And so yesterday, Jeremy Hunt said, today the government and the Bank of England have facilitated a private sale of Silicon Valley Bank UK. This ensures the customer deposits are protected and can bank as normal with no taxpayer support. And HSBC bought the bank for £1. Now, I wonder what the market response to this was, David. Well, here we go. Here is the latest stock price. It is down 4.3% today, 4.03%, sorry, today. So the market's not massively excited. Meanwhile, in the US, we have no federal bailout for collapsed Silicon Valley Bank, says Janet Yellen. Well, actually, we've got a quote from her here. Well, let me say, America's economy relies on a safe and sound banking system that can provide for the credit needs of our households and our businesses. And my question, David, is that true? And does the actions of the Federal Reserve Bank in the last couple of days demonstrate that to be true?
Safe and sound banking system. Well, you said we're not going to bail out the Silicon Valley Bank, and indeed they're not. What they're going to do instead is they're going to bail out the entire United States banking system. So we have the press release, and it's a stunning document. It's from the Board of Governors, dated March 12th, 2023. Federal Reserve Board announces it will make available additional funding to eligible depository institutions, banks, to help assure banks have the ability to meet the needs of all of their depositors. So the Fed is funding the entire banking system. It reads, to support American business and households, there we go, well, it must be true, it's in this press release, the Federal Reserve Board announced on Sunday, right, you know it's a panic, on Sunday, announced that it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. This action will bolster the capacity of the banking system to safeguard deposits and ensure the ongoing provision of money and credit to the economy. So this is an admission that all of these things were under threat. The Federal Reserve is prepared to address any liquidity pressures that may arise. So this is unlimited money, right? There is no upper limit. They will print as much as they need. Let's go and have a look at some more detail. The additional funding will be made available through the creation of a new Bank Term Funding Program, BTFP, offering loans of up to 1 year in length to banks, saving associations, credit unions, and other eligible depository institutions pledging United States, US Treasuries, agency debt, and mortgage-backed securities and other qualifying assets as collateral. These assets will be valued at par. Now, these assets are not valued at par. If they were marked to market, they would be very much below par. So they're putting a false valuation on the assets, and then the Fed's lending unlimited funds, essentially, against those assets. The BTFP will be an additional source of liquidity against high-quality securities. Okay, we'll come to that. Eliminating an institution's need to quickly sell those securities in times of stress, because obviously if they were forced to sell, they would take such losses that all the institutions would be bankrupt. With the approval of Treasury Secretary and Department of Treasury, we will make available up to $25 billion from the Exchange Stabilisation Fund as a backstop for the BTFP. The Federal Reserve does not anticipate it will be necessary to draw on these backstop funds. And it continues, after receiving recommendations from the board, Treasury Secretary Yellen, after consultation with the President, approved the actions of the FDIC to complete its resolutions of Silicon Valley Bank and Signature Bank in a manner that fully protects all depositors, both insured and uninsured. Does that not sound a bit like a bailout? Well, maybe a little bit. These actions will reduce stress across the financial system, support financial stability, and minimise any impact on business, households, taxpayers, and the broader economy. The board is monitoring developments. The capital and liquidity positions of the US banking system are strong. That's why we're having an enormous bailout. And the US financial system is resilient, right? So there's two lies in one sentence. That's quite impressive. Depository institutions may obtain liquidity against a wide range of collateral through a discount window which remains open and available. In addition, the discount window will apply the same margins used for securities eligible for the BTFP for the increase in lendable value at the window. The board is closely monitoring conditions across the financial system and is prepared to use its full range of tools to support households and businesses and take additional steps as appropriate, which means, as always, the Fed has not run out of ammunition yet. They can bomb the economy some more if they need. And that is basically a huge pivot. We're now creating additional funds into the banking system in order to meet the stresses that have suddenly become apparent. And we'll now have a little look as to why these stresses have suddenly become apparent. Because, of course, we've been putting up interest rates. They created a lot of money. They created a lot of currency. And this created an increase in prices, incorrectly called inflation. And to cope with inflation, the Fed and all the other banks, having denied that inflation was there for around a year, decided to start to put up interest rates. This is having some effects. Here we see the first of the effects. Federal government, current expenditure, interest payment. Now this is a bit out of date. This is from the end of December. And you see there that the interest payment is shooting up. It was 853 billion then. It will be around $1 trillion now, I would guess. We haven't got the absolute up-to-date figures, but at the end of the year, it was $853 billion, which is quite a lot of money. Compare that to the tax receipts, which are 3.22 trillion, and you see that 26.5% of all United States revenues at the end of the year, the end of last year, were going on interest payments. And that's just when they'd started to increase interest rates. It will be worse now. It's probably about a third. At what point does it become untenable? Well, probably quite soon. And if you look at the Federal Reserve total assets, this is how much money creation they've done. You see this graph and you see the 2009 spike. That was the huge bailout, the biggest bailout in history back then. And then they did that again, essentially in about 2012 to 2014. And then we got to 2020 and they did about 2.5 times more. And then they continued printing again the equivalent of the bailout and more up to 2022. And having taken their balance sheet from 1 trillion to just under 9, they drew it back by about $500 billion. And of course, they've broken the banking system. And the federal funds rate, you see there, why is all this strange things happening? Well, up until about 2020, there was things called interest rates. And then up to about the year 2000, there was things called interest rates. And then after the year 2000, not so much. And we're trying to put interest rates back up to normal after 22 years of abnormally low interest rates, and things are breaking.
Yes, Brian.
Well, David, my comment is that we need to be asking exactly who the Federal Reserve is and to whom they're accountable. Because what we've got happening is a very muddy pond here where people are making massive decisions which affect the whole economy, supposedly one of the biggest in the world. And the key question is, who is the Federal Reserve? To whom are they accountable? And when are they going to be held to account? Now, I know you're going to move on in a minute to the Bank of International Settlements, but we've got exactly the same question. We've got one super bank, the Bank of International Settlement, which, as we've covered on the UK column a little while ago, is happy to operate in this country under diplomatic immunity to make decisions concerning what other world banks can and can't do. So we've got the problem that we're experiencing at the moment, but the key point is, who are these people and why are they allowed to get away with running a business to their entire satisfaction?
And it's a very vague answer because obviously the Federal Reserve are not federal, it's a private bank, and yet they're hugely tied in by regulation, by statute, by responsibilities to the Treasury Department, and you get this strange public-private partnership between the private bank and the public interest, and it's very difficult to say exactly where one stops and the other starts. Now, we saw the Federal Reserve funds rate. So the plan is, the explanation is, we're going to put up interest rates, and we're going to do so aggressively because we're going to conquer inflation. We are the Fed, trust us. I came across this little tool. You might like to have a look at it online. This is the CME Fed Watch tool. This is looking at the probabilities looking forward as to how the market sees what the Fed is going to do. Now, at the moment, the federal funds effective rate is 4.5%. And the betting here is in the 22nd of March federal meeting, that will go up by either 1/4 or 0.5% to 4.75 or 5%. So that's what the current thinking is. If we go forward to September, we see that the main view is that we'll go up to between 5% and 5.25%. So the mainstream thinking currently is that it's only got another 0.5 or 0.75% to go. After this, the expected interest rates actually come down. So the market isn't believing the Fed that it's going to be aggressive on interest rates and aggressive against inflation via this source. It doesn't believe it can do it. And it's been proven over this last weekend to be correct. The plan, we're going to conquer interest rates by cranking up we're going to conquer inflation by cranking up interest rates, conquer what they call inflation by cranking up interest rates, doesn't work because what happens very quickly is you break the economy. You've got an entire financial sector which is entirely reliant on easy money policy from the Fed, zero interest rate policy over some 20 years, and to try and correct that, things go bang. And we've just seen them going bang, and when they go bang, the response is to create more money printing, more easy money from the Fed to bail out the banking system. There's many other things that come from the easy money policy the Fed's been running, and one of these is what's called zombie businesses. Now, you mentioned the Bank of International Settlements. Now, Bank of International Settlements do many things, but they do occasionally produce an interesting report or two. And we have one here. So this is a working paper, number 882, Corporate Zombies, Anatomy and Life Cycle. So they introduce the concept. They say there's these things called zombie firms, firms that are unprofitable but remain in the market rather than exiting through takeover or bankruptcy. They don't make any money. They just continue to exist. And the first graph there shows that since 2005 to 2020, there's been much more public debate about these issues. Now, the key graph here is, up until 2000, this is the survival probability of zombie firms and non-zombie firms. So before the year 2000, which was before zero interest rate policy, if you had a non-zombie, a profitable firm, right, and about 12 years out, you would have a 70% chance of still having that firm in existence, right? But if it was a zombie firm, you would only have around a 50% chance of having that firm in existence. So having a zombie firm was a bad thing. Do you want to see the equivalent under zero interest rate policy since the year 2000? Here it is. Right? There's no difference. It doesn't matter whether your firm's a zombie or not. free money, easy money policy will keep all the firms basically in the same position. They're both about, after 12 years, about 55% likelihood of existence. It doesn't make any difference whether it's a zombie or not. So this shows how zero interest rate policy has kept all the deadwood in place. All the sick firms, all the non-performing zombie firms have simply hung around. This is basically a brush fire waiting to happen. As interest rates go up, these firms will be made untenable and must have their assets liquidated and redistributed to productive use. This will be another big aspect of what's about to befall us. All because zero interest rate policy has simply built problems in that we're now having to deal with. We've got ZeroHedge here with a very astute comment. They're asking, why are venture capital icons ganging up and Lehmanizing the Silicon Valley Bank? He says, well, if your business model relied on quantitative easing, wouldn't you try and trigger the next quantitative easing too? Yeah, well, indeed.
Yeah, okay, David, thank you very much for that. Mark, I don't know if you've got any thoughts on this.
Boy, there's so many things you could say. Going back to the Federal Reserve, I just remember covering the House Banking Committee a few years back. And one of the things about the Fed that isn't often discussed is, rather than the Fed being regulated, the Fed has become a major regulator of the economy. It plays a pretty big role in enacting regulation and overseeing the economy. So the Fed, while it's nominally owned by the commercial banks, and it probably answers ultimately to the Bank for International Settlements, the Fed is pretty much as independent as you're going to get as it performs regulating functions rather than being on the receiving end of regulations. And the only other thing I would add is its actions with Silicon Valley Bank. One of the things that came out when you were talking, Mike, was the raising of the interest rates depressed economic activity, and those public offerings became less frequent. It became harder for businesses to get on their feet. So therefore, they grabbed their money out of the bank because they couldn't get it through the other means due to those interest rates. So when the Fed tries to raise interest rates, or when it does raise interest rates to control inflation, it also depresses economic activity. And some of those interest rates are costs that are passed on to the end consumer through what's called cost push inflation, while we also have demand pull inflation that David talks about. That's my quote, 2 cents I would throw in briefly.
Okay, brilliant. Thank you for that.